So first blueprint item, I'm on the first page of content section 2, which is 2A-1, is the blueprint says you need to be able to explain the purpose and the significance of the auditor developing an overall engagement strategy for an audit or even, and also a non-audit engagement, okay? So I can tell you from experience, the first thing you do when you go out to the client and you start the audit is to develop an overall strategy and come up with an audit plan, okay? And it really starts with what I would call business basics, okay? You know, you organize an engagement team, and you start to develop your audit strategy, okay? Now, if it's a client you had last year, you obviously have those work papers to go back to and the results of last year's audit. If it's a new client, you have to do quite a few more new procedures. If you remember last week under ethics, right, we talked about some topics related to vetting a new audit client and checking their background, et cetera, okay? But basically here you have 12 items, okay, that are encompassed in the planning of an audit, right? And first of all, of course, obtaining knowledge about what is the company's internal control or financial reporting. Then you assess the industry. Is it a growing industry? Is it a declining industry? Is it competitive, super competitive, hyper competitive? And what does that mean to financial reporting practices? Okay, you also then look at the organization structure of the business. Has it changed since last year? The capital structure. Any big changes within the company or its operations in the past year? Then the auditor makes preliminary judgments about materiality. We will cover materiality tomorrow in part 2 of content section 2. What is the materiality that probably we're going to go with on this audit? In other words, what adjustments that we find are going to be material to the financial statements, and we're going to request the client to record them, okay? What is the risk for this particular client? That's also a big area, right? Look at the balance sheet and assess the balance sheet accounts with risks, okay? Look back at last year. What were the control deficiencies that we communicated to the audit committee? Any changes in legal or regulatory matters that affect this client? The type and extent of evidence related to internal control over financial reporting is assessed. Preliminary judgments are made about internal controls. Public information, right? You can't ignore the internet, right? And see if there's been anything on the internet or Twitter or Facebook or anything else, right? That could be something to consider as part of the assessment of risk and also internal controls, okay? Negative publicity, you know, lawsuits, et cetera. And then knowledge about the risks, right? And then that's all evaluated as, should we continue to accept this client if it's new, or retain it if it's an existing client? And then number 12, any changes in the relative complexity of the client's operations. So John, if the operations got more complex, what does that do to risk?
Increases it.
Automatically, right? You can't rely on what you decided last year or what you did last year. You know, if they acquired another company or they started a brand new product line, which is hyper competitive, right, et cetera, et cetera. A lot of this, candidates, is common sense, okay? When you're getting questions on the exam, think common sense, okay? If you were a business person facing that question, or, you know, trying to get the best answer to that question, what answer makes the best sense, okay? Planning is not a discrete phase of the audit, but it's continual and iterative, okay? And it often begins shortly after the previous audit ends, and it continues until you complete the current audit, okay? It includes consideration of timing of certain activities and audit procedures that need to be completed prior to performing the other audit procedures. For example, prior to the auditor's identification and assessment of the risk of material misstatements. One of the big things, and please remember this, is analytical review procedures are performed. What's an example, Deanna, of an analytical review procedure that an auditor would perform at the beginning of the audit?
Compare this year's financials with last year's.
Perfect.
Or compare this year's financials to the latest interim financials.
Yep, and compare this year's financial statements to the budget for the year, right?
For variances, yep.
Yep, for variances, okay, good. So this is big, okay? I would be shocked if you don't get a question or two, multiple choice, on the role of analytical procedures. And Deanna, is it done at the beginning of the audit and at the end of the audit?
It's required to be done at the beginning and at the review stage at the end, and it's optional during the audit.
Good, but it's a good procedure, right, to do at the end of the audit, right, just to see what changed from the beginning?
Yeah, it's required.
Yeah, very good. Okay, then next is legal and regulatory framework. If there's been any new government regulations, state regulations that apply to the client, you have to look at that. Okay, materiality, we said. Involvement of specialists. Okay, we're going to talk more about this, but if on the balance sheet, John, there are big items requiring estimates by management, like goodwill valuation. Remember that from FAR? Okay.
Yeah.
The future cash flows from major fixed asset investments. Okay. The auditor may have to go outside and hire specialists, right, to corroborate management's estimates for key critical audit matters that are on the balance sheet where estimates are involved. Okay. So keep that in mind, right? And then the performance of other risk assessment procedures. In other words, comb through the balance sheet and identify areas of the balance sheet that are risky, okay? Contingencies, lawsuits, okay? These type of things. All right, so the auditor should establish an overall audit strategy, and that's going to set the scope, timing, and direction of the audit, and it will guide the development of the audit plan, okay? And we said some of these already, right? Consider industry situation, complexity, what accounting principles the company applies or is using, especially those that require judgment, risk areas, and major estimates. Please, candidate, remember these. These are big, right? In audit planning. How complex? What accounting principles? Where are the risks? Where are the major estimates that management must make? Okay. Deanna, other areas of the balance sheet where management make estimates, can you tell us a few?
Allowance for uncollectible accounts.
Good. What else?
Valuation of equity investments.
Where there's not a trading price for the stock of the company they invested in.
Correct.
Okay. What else? What about inventory?
I don't know.
A slow-moving obsolete.
Inventory, yep.
Right. Those are estimates, aren't they?
Yes, they are.
Absolutely. There's no concrete way to estimate those things. Okay. So that's why major estimates, right here, that's a big item, okay, in the planning process of the audit. How did management make those estimates? Are they reasonable? How do we corroborate them? Do we need specialists to help us verify that those estimates are fair and reasonable? Are they going to be absolutely correct, Deanna?
No.
Of course not.
Reasonable in the circumstances.
Reasonable
estimates.
Circumstances, right? The financial statements are what? Fairly stated. Right, Robin? Fairly stated.
It's stated, yeah.
Yeah.
And these are estimates. You're not going to get a guarantee.
Yes, exactly. All right. So then the auditor includes in the work papers right? They document their overall audit strategy, they document the audit plan, and then they document any significant changes they make during the audit, right? Because as you do the audit, you may encounter many new items or situations, right, that require to go back to the audit plan and alter it, right, to do more testing or whatever it may be. Okay. And then, okay, so next, developing that detailed engagement plan. And there's the blueprint. Prepare a detailed engagement plan for an audit or non-audit engagement, starting with the prior year engagement plan or with a template, right? So these could be multiple choice questions, and it also could be a sim where they give you in a simulation a drop-down exhibit giving you information about planning, and they'll ask you a series of questions with options where you have to pick the best option. Okay. So the auditor should develop an audit plan includes description of, and this is key, nature and extent of planned risk assessment procedures. You notice how that's number one. Okay. Auditors not worried about accounts that are not risky so much, right? Like cash, if the bank rec is done and the cash bank accounts reconcile and the investments on the balance sheet reconcile to the statements from whoever they do the investments with, those are not very risky, okay? More important is documenting in the work papers the nature and extent of planned risk assessment procedures, okay? And again, you don't have to memorize these code sections or auditing sections, but that's the one that addresses it. The nature, timing, and extent of planned further audit procedures at the relevant assertion level, okay? In other words, management asserts, right, that the allowance for doubtful.
Thank you for previewing the Yaeger CPA Review course materials. To learn more or to purchase the full course, visit YaegerCPAReview.com or click the link in the description.